staking is such a broad term. People associate it with a lot of the, I wouldn't so much call it fraudulent activity, but staking where it is a bit more of a Ponzi scheme, or you can stake all sorts of different things. But that term doesn't apply to the staking that we're going to talk about today. Okay. And that's when you stake cryptocurrency on a proof of stake blockchain. So if we just jump to the next slide here, we'll dig into kind of some of the basics around what that is. And so this is just literally the process of securing a blockchain network that uses a proof of stake consensus mechanism. It's how transactions are validated. We won't get into all the specifics, but you're really helping to make the blockchain work, so to speak. It doesn't really run without this mechanism. And so when you stake in a proof of stake blockchain, you're contributing to really, its functionality. And when you do that, you receive rewards in the form of the native currency of the blockchain. Ethereum is the biggest proof of stake chain. The rewards are paid in Ethereum. So if you're bullish on Ethereum and you're staking, you generate yield in the form of these rewards, and hopefully it goes up over time. And like I said, this is a feature of proof of stake blockchains such as Ethereum, but not proof of work like Bitcoin. So whenever you see something out there where stake your Bitcoin, it's not the same thing that we're talking about. That's more of lend your Bitcoin and hopefully you get some return on it. And that's an area where we've seen the SEC crack down a bit.
Okay. Yeah, well, I don't know anybody that does that, but,
Well, when we look at Kraken, for example, you could stake Bitcoin with Kraken.
Oh, okay.
The SEC has come after them for a couple of reasons, but not to kind of shine a negative light on them. Their staking program outside the U.S. is still running, but just when you see those kind of things, you got to ask a little bit of some questions around what really is going on.
So all staking's not the same.
That's the best way to put it. All staking is not the same. Okay. What we're talking about is staking on a proof of stake blockchain. And so if we jump to the next slide, just really quickly, I want to touch on the differences between proof of stake, proof of work. Proof of work, I think a lot of people have seen some of the negative headlines in the news around the environmental impact. Uses a lot of energy, a lot of computing power, where you have miners all racing to verify transactions. And the reward that goes to those miners only goes to the one miner that solves that transaction first. Where in proof of stake, you have validators that are randomly selected. There's not a lot of computing power. There's this view that you'll eventually be able to run a validator on your smartphone. So it's much more energy efficient, but there's some trade-offs too. There's the argument that it's not as secure because of that. But the point here is that the proof of stake rewards go to those validators. They're randomly selected, they validate the transaction, secure the network. And if you have a lot of Ethereum, for example, there's a higher probability that you're going to be selected to validate a transaction. And there will be points in time too where those rewards are going to be variable. So if there's a lot of activity on the network, fees are high, you're going to see a largely, greater rewards compared to times where there's not a lot going on. And if we jump to the next slide, just to kind of give you a view of the growth of this activity, if we go back to January 2021, there's been some upgrades to the Ethereum network over time that have made it much more efficient to stake, maybe give people more of a reason to stake. And you can see here that that's certainly grown in terms of the amount of Ethereum that's been staked as well as the validators.
It's crazy. Yeah, that's huge.
And I
what is the total number now?
So if we jump to the next slide right now, we've got about 19 million in terms of Ethereum that's staked. This is the number of Ethereum.
That feels like, that's just the number of Ethereum coins.
That's right, yeah.
Okay.
So 16% of the circulating supply, right around 16%, is how much is currently staked. There's 584,000 validators. I think in the last chart we just showed there was over 600,000, but this is the current number. And that revenue, if we annualize the last 30 days, we're running right now at about $5 billion in revenue. This is rewards that's paid out on chain to those that are staking. And so you get then, in the case that you're running your own node, and we'll talk about that in just a second, but if you're doing this in a way where you can take advantage of the rewards like fully, let's say, you're looking at a yield between 8 and 9% right now. That can fluctuate. It's certainly been lower and it can be higher. But what's kind of interesting about this, if you believe, let's say, that there is some element to this a role that it might play in a financial system, or it's a financial system in itself, you have, I wouldn't call it a risk-free rate, but you have kind of a benchmark rate here, right? If we trust in Ethereum, if we believe it's real, if it's the biggest, this is where the majority of the activity is, then when you see something in this space where you have these ridiculous yields, right? 20%, 40%, you can at least benchmark that against what your pseudo risk-free rate might be here. There's also an argument that given how long you might lock your position up on chain when you're staking, maybe you could have a yield curve as a result within Ethereum in terms of the ecosystem, where if you're willing to take more risk and stake for a longer period of time,
You get a higher return?
you could get a higher return
Is
relative.
that the way it works?
Not exactly, but in terms of...
Is the return tied to treasuries at all?
No, it's not tied
Okay.
to anything that's kind of happening.
So the 8 to 9% is just all supply and demand?
Yes, yeah. So we certainly would see that collapse if the price went down, but it's exactly that. It's supply and demand, and it's just where we are as a function of rewards that are paid. So that's where we're at today. That's what I think is kind of interesting. At least it provides a way to model what's the risk, in some other project. Not that they're not all risky, but at least it gives you, some basis in reality of what yields you should maybe be generating. So all that said, if we jump to the next slide, I want to talk about some of the ways that you can stake cryptocurrency, because it's important to know the differences here. You could do this on your own. You can go solo. You can run a validator node. This is difficult to do in terms of that there's higher technical complexity. There's a much higher capital requirement. You need 32 ETH to run a validator node. So you need a bit of money, a bit of capital up front, but you receive the entire reward as a result. Where if you look at some of the other ways that you can stake, you can use an exchange, such as a Coinbase or a Kraken or others. You alluded to some of the things we might be working on, Tom. But you can just simply use staking as a service. You can hold tokens at these exchanges, and they're going to take care of the rest of the process. They're also going to take a good chunk of the spread. And that would be the trade-off here, where very easy to do, just really own the token and receive some reward, but you're not going to get 8 or 9%, not even close. And you can look at how much some of these companies I've mentioned have made on their staking programs. The other thing.
So it's not an easy thing to do, is what you're trying to say here, right?
What do they take fee-wise?
So I'll have to go back and look at all of the fees that are listed. I'm not sure if they've changed it all, but I think from what I've seen, some of these larger exchanges are taking 20% of the reward. Yeah,
That's what I thought.
it's a decent amount. And anybody watching can check me, but I think Coinbase made a few $100 million with staking as a service when the times were a little bit better than they are today. But the other way that you can do this, and this is what's kind of cool in my opinion about what we're doing with the wallet, is that you can be your own custodian, own your crypto, participate in this, and you don't have to run your own validator node. You can use a decentralized staking service. And we'll talk about a couple of those in just a second. But in the same way that you are depositing into, let's say, an automated market maker liquidity pool, like we've talked about with decentralized exchange, or we talked about with options trading last week, you are locking your tokens into a protocol, into a smart contract that's going to go out and do a lot of this for you. So it's it's the exchange staking, or staking as a service in that sense, but it's decentralized. You are in a bit more control, I suppose, though there's some risks to that as well. So these are the three primary ways that you can stake or run a validator, participate is probably a better term. And if we look at where is all this activity, where are the stakers on the next slide, decentralized staking actually accounts for about 31% of all the ETH that's currently staked. So we've got LIDO, which is a decentralized staking protocol. I'll talk a little bit about how that works in a second. Then we've got some familiar names up there, centralized exchanges, Coinbase, Binance, and Kraken. We've got Rocket Pool, which is another decentralized exchange staking platform. So you can see where we are right now in terms of that 16% of the outstanding supply. Where is it actually being staked? And it's DeFi really leading the charge. How do you do that then? On the next slide, if you want to participate in something like a LIDO or a Rocket Pool, in the Tasty Crypto wallet, you'll eventually be able to go to LIDO or Rocket Pool, connect And then simply, you can deposit your tokens and you can stake fractions of a token. Benefit here is you do not need 32 ETH. You're not running your own node. You're just participating. You receive rewards. And so you stake your Ethereum. The pool mints what's called staked Ethereum, which we have there. It's a token that represents your share. You can kind of think of it as a receipt. And from there, when you want to remove that Ethereum, what you're doing is you're basically burning that staked Ethereum token. You're unlocking your Ethereum as part of this. And so I'm using a bit of jargon, but it's just what's happening technically.
I'm so sorry. What do you mean? You've said it a few times, 32E. You need 32 coins?
Yes, you need 32 tokens to be able to participate as a validator and run your own node on the Ethereum.
It's like 50.
the-
It's like 50 grand.
Right. Well,
It's a lot for
so
a lot of
it's a
people.
lot for somebody speculating on cryptocurrency to do this. I mean, the average size trading account is in that area.
What
so
surprises me is that the 8 to 9%.
you'll never get anything close to that.
What?
Well, if you're running your own node, you will. Or
Oh.
if you're participating in a DeFi staking protocol, you're going to be closer to that.
No, I feel like it's not enough.
Centralized.
Oh,
Oh, yeah.
well, it's even less.
I feel like it's not enough if you're talking about like 5% short-term rates,
Yeah, I think when you compare it to treasuries and where they are right now, I agree with you.
because there's risk. There are other risks.
There are.
Yeah. So have you talked about the risk yet?
We will
Okay.
in just a second. Yeah,
Okay.
there are. But I think, well, is your view that, I guess, U.S. Treasuries stay at 5%?
No, but you can lock in, 2 years at 4.5. Like I don't know what the ratio should be, but it should. It feels like, getting paid 2x is. I mean, I don't know if that's worth the risk. That's all.
Yeah.
That'd be my thought.
Yeah, 2x, you're just talking about 2x of the 4.5%.
I mean, if rates are 0, then 8 or 9% is attractive. If rates are 4.5%,
Guaranteed rates.
yeah, risk-free
Well, I mean,
rates.
risk-free rates. I'm just saying, yes.
I mean, risk-free, excluding the debt crisis, but risk-free rates.
Yes,
Right.
yes.
If risk-free rates are 4.5%, is 8% worth it? I don't know.
Yeah.
You
So,
know-
I mean, I agree. This is definitely less attractive on a yield basis relative to where we were even just a year ago, a little bit over a year ago. But I think for the majority of people here that do this, you have to already be very bullish on Ethereum.
Sure.
Right? And so you're holding this asset. Why not generate yield? It's not that you're capping your upside or anything. You are just taking risk to participate in this system. You're still holding the asset, or you have that upside exposure, and you're really just earning more of it. So if you're bullish, I suppose this is a way to express a super bullish view from a kind of risk perspective in that sense. But if you obviously if you see, let's say, treasury yields fall substantially, then maybe it's more attractive from a yield perspective. So on the next slide, then I just want to talk a little bit about some of those risks, so everyone is aware. Keep it balanced here. I'm a bit bullish on this, if you can't tell. But your biggest risk here, and this is true for everything that we talk about as it pertains to DeFi on the show, but you have that platform or smart contract risk. This stuff is super interesting, but it's only been around for a couple of years. When you read about these hacks in the news that seem to happen frequently, at least at this stage in the industry, it's usually because there's been a smart contract that's been exploited and it's been drained of all of the capital.
And that's
terrifying.
But that's terrifying. That's right. So like that's the whole point. Like if a risk-free rate is 4.5%, how could 8%? I mean, I understand there's a lot of players, so it's not.
So I would say these risks are specific to the DeFi staking, the things that you'll ultimately be able to do, or you can do today with a self-custody wallet, but ultimately with ours, with Tasty Crypto. So these risks are specific to that. When you just look at running your own validator, there's some risks that technically you might mess it up and you'll be penalized as a result. But the larger risk then that we're arguing about, or not arguing, but discussing is, well, would the Ethereum blockchain break, so to speak? Is Ethereum going away? I think that's the real risk here, where you don't so much have that, kind of that platform risk in the same way that you do with a DeFi protocol. But it is certainly important to be aware of. And I think, in my own personal opinion, you want to make sure that any protocol you're using, first of all, it's been audited, but you do a little bit of research. There's a lot of stuff that just pops up. Don't just connect to it right away.
It's hard to do research. I mean, it's such an that's such a crazy kind of assumption because, in fairness, that like how's Tony or how am I going to do research? How's Tony going to do research?
Well, hopefully we're
going to ask somebody like you. That's our research.
Help with that. Well, hopefully I've done my research in that sense.
Yeah, but you can't protect against fraud or criminal activity. Like that's the whole thing. If there's a bad actor out there, if there's a bad player, that's the dangerous part. I mean, I think the cool part is that when you think about the concept of, proof of stake or staking, it's really a cool concept.
It is, yeah.
It's freaking, that's cool technology. And I can tell you that, with the stuff that we're thinking about right now, like we're building, a new exchange again. And the stuff that we're thinking and how our minds are working are very similar in using some of the DeFi, just using some of the decentralized exchange logic and how they kind of validate everything, and using that logic on a listed exchange is kind of how our minds are thinking, because that I do believe this is the future.
Oh, absolutely.
There's no way we're going like this. The current system we're in only has so much capacity, and it's also it's these are all everything about it is all legacy going back 20, 30, 40, 50 years, whatever it is. It's all going to change.
Yeah.
And we're going to go eventually to much more of a peer-to-peer. I'm going to trade with you, and it's going to be validated by, it's going to be guaranteed, it's going to be fungible, there's going to be all this stuff. And so the exchanges of the future have to recognize that. I'm just not sure how to get there
from
yet.
A to Z.
Yeah.
Well, nobody knows.
Of course.
Yeah.
Of course.
Oh, and it's going to take a lot longer than we probably all anticipate. But yeah, I completely agree with you as well.
I can't even get my Venmo turned back. I mean, you know what I mean? Like, once you send something, if it's a mistake and both parties accept that it's a mistake, I mean, okay,
Right. Yeah, so there's got to be some improvements there. But I hate to throw out the term, it's so widely used, but democratization of everything. Mm-hmm. But I think you will largely see that, whether it's financial services or it's just identity and privacy, you're going to see less of the rent-seeking kind of institutions that might exist today, and you're going to get more.
Well, anything that cuts out the middleman is essentially going to be, is going to be embraced. So that's why, and also, as people become. As people, everybody's smart, and people can see, it's the same thing that's going to happen to everything that's inefficient. So it's going to happen to sports gambling markets. It's going to happen to, gambling markets all over the world. It's going to happen to exchanges everywhere. Anywhere there's an inefficient marketplace, between AI and decentralized technology, they're going to arb out the middleman.
Absolutely.
They have to.
Absolutely.
It's the only money that's left that's considered like free money, even though it's not free money. But it's and then there's going to be
it's fat.
It's
relative
fat.
to
they're going to take the fat out. But then there's bad actors. So then you've got to get rid of the bad actors in the process, which is always the challenging part. So.
I want to dig into that for just 1 second before we wrap up, then, because it brings up a really interesting point or important question. We, in a capacity, right, we act as a financial intermediary. Tasty Trade does. The company. How do you see existing intermediaries participating in this world? Do they just go away, or do they play a different role? How do you think about that?
Well, we don't see ourselves as an intermediary. We see ourselves as a facilitator.
Okay.
So facilitators don't go away. They just change. So today we facilitate in a more traditional sense, and hopefully, we're among the market leaders to facilitate at a higher level of technology. But you're always going to need. Somebody always has to build the technology. There's always going to be a facilitator. Or I shouldn't say always, but I think there's always going to be a facilitator. And so essentially that's where we see ourselves.
Okay.
So our role, we view our role, and I'm not talking about Tasty Live, because Tasty Live is a, content creator, content marketing, whatever you want to call us. Tasty Trade is a facilitator of opportunity to anybody that wants to play in the financial arena. That's going to change over time, over the next decade, in that our technology is going to get smarter. Our technology is going to look more like decentralized technology, but we're also going to play in an old playground and a new playground. So that's why. So as a facilitator, we're just going to get better, and the rates will come down. Like everything will be cheaper.
Well, maybe we leave it at that.
It's going to be all gummy bears and rainbows too. I mean, is that easy?
We need to test this out, though. I agree with you. We've got to get into this different playground. A couple $1 million on a Uniswap pool, Tom. We got to learn about it a little bit. What do you think?
No, I agree.
Yeah.
I agree. We have to be. I agree with you.
Well, there might be a role to create products around that too, which we'll talk about on another.
I think we're already trying to do it with the new exchange technology, but yes, there is.
Well, that's it for staking. We can get into the regulations and whatnot, but I guess the last point that I just want to make here, and it's really just too early to tell, like most of crypto, at least in the US, a lot of regulatory uncertainty, to say the least. But what you are seeing, and maybe this gets regulated away as well, but as a result of what's happening, what happened to Kraken, it's been an explosion in DeFi staking services. So it kind of just moves from one area to the next, and that's
It's not widely held enough yet. That's the problem. So as things get more widely held, and as it becomes more ingrained in the hands of where all the money is. See, right now there's not enough money in it, but when it gets to that point, it will be very interesting when there's a different level of. So right now, like I don't want to put my money with Binance or Kraken. But if Tasty did it, I would do it.
Do you think that money is that retail flow or is that institutional flow that's not there? Is there an opportunity?
There's no institutional flow. It's all retail. There's prop flow, but it's all retail.
So in a way, I mean, is it an opportunity for retail investors that you can get in before that flow?
I don't think there is, unfortunately, yet because of all the regulatory pressure on firms like us. So even if we want to do it, we can't. Because so we're trying to be proactive. Like that's why you have the role that you have with us. But the problem is that the regulators just won't let us do anything right now. But we're gonna get there.
So no pressure.
Yeah. No pressure. I mean, you know, it's like if we could do it, we would.
Absolutely.
Yeah.
Well, we'll get there. So
yeah.
Good job out of you, my friend. We're going to take a quick 90-second break and come back. We got more Tasty Live coming up in about 90 seconds with a market measure next.